Today, we're diving deep into a unique exchange-traded fund, the PFFA ETF. Now, this isn't your standard stock picker. It focuses on something different: preferred stocks. These offer a steady stream of income, but there's more to the story. Is the PFFA ETF a hidden gem or a risky gamble? We'll explore the fees, the potential returns, and how it handles those ups and downs in the market. So, whether you're a seasoned investor or just starting out, stick around to see if the PFFA ETF could be the right fit for you. What is the underlying investment objective of the PFFA ETF? The underlying investment objective of the Virtus InfraCap US Preferred Stock ETF, PFFA, is twofold. 1. Current income. This is the primary objective of the PFFA ETF. It seeks to generate consistent income for investors through regular distributions. Preferred stocks, which are the core holdings of the ETF, offer fixed dividend payments that take priority over common stock dividends. The PFFA ETF aims to capture this income stream by investing in a diversified basket of preferred stocks. 2. Secondary capital appreciation. While income generation is the main focus, the PFFA ETF also seeks to achieve capital appreciation, but this is considered a secondary objective. Capital appreciation can occur in a few ways. Price increase of preferred stocks. If the underlying preferred stocks in the ETF increase in value, the overall net asset value, NAV, of the ETF will also rise. Investors can then potentially sell their ETF shares at a profit. Reinvestment of dividends. The ETF may choose to reinvest the dividends received from the preferred stocks back into purchasing additional shares of the holdings. This compounding effect can lead to growth in the ETF's share price over time. Here's a breakdown of some key points to consider. Focus on income. The PFFA ETF is designed for investors seeking a steady stream of income. This can be attractive for retirees or those building a portfolio for income generation. Active management. Unlike some index-based ETFs, the PFFA ETF is actively managed. The fund manager selects individual preferred stocks based on their analysis for optimal income generation and potential capital appreciation. Secondary capital appreciation. While the PFFA ETF does have the potential for capital appreciation, it's not the primary focus. Investors seeking aggressive growth might consider other investment options. How does the PFFA ETF achieve its investment objective? The PFFA ETF achieves its dual objective of current income and secondary capital appreciation through a combination of strategic portfolio construction and active management by the fund manager. Here's a deeper dive into how it works. 1. Investment in preferred stocks. The core holding of the PFFA ETF is a basket of U.S. preferred stocks. These are a special class of stock issued by corporations that offer several advantages for achieving the ETF's objective. Fixed dividend payments. Unlike common stocks, preferred stocks come with a predetermined dividend payout. This fixed income stream is a reliable source of income for the ETF and its investors. Dividend priority. Preferred stockholders have priority over common stockholders when it comes to receiving dividend payments. This ensures a more stable income stream for the ETF even if the company's profitability fluctuates. Variety of preferred stocks. The PFFA ETF doesn't simply pick a single type of preferred stock. The fund manager actively selects a diversified pool of preferred stocks with varying characteristics like yield. Some preferred stocks offer higher dividend yields, which translates to more income for the ETF. Credit quality. The creditworthiness of the issuing company determines the risk associated with the preferred stock. The PFFA ETF might balance high yield, higher risk options with lower yield, but investment grade options for a balance of income and stability. Call features. Some preferred stocks have a call provision that allows the issuing company to buy back the shares at a predetermined price after a certain period. This can impact the potential capital appreciation of the stock, but the call price might also be higher than the purchase price, leading to a capital gain for the ETF if called. 2. Active management by the fund manager. The PFFA ETF isn't passively following an index. The fund manager plays a crucial role in achieving the investment objective through active management strategies. Security selection. The manager analyzes individual preferred stocks based on their expected dividend yield, creditworthiness of the issuer, call provisions, and potential for capital appreciation. They then select a basket of stocks that best aligns with the ETF's objectives. Portfolio weighting. The manager determines how much of the ETF's assets will be allocated to each chosen preferred stock. This weighting considers factors like the desired income stream, risk profile, and diversification within the portfolio. Rebalancing. The manager periodically reviews and rebalances the portfolio to ensure it remains aligned with the investment objective. This might involve selling off stocks that have underperformed or reinvesting dividends to maintain the desired income and risk profile. 3. Secondary capital appreciation. While income generation is the primary focus, the PFFA ETF can achieve some capital appreciation in a couple of ways. Price increase of preferred stocks. If the market value of the underlying preferred stocks held by the ETF increases, the overall net asset value, NAV, of the ETF will also rise. Investors can then benefit by selling their ETF shares at a profit. Factors like interest rates, overall market conditions, and the issuing company's performance can influence the price of preferred stocks. Dividend reinvestment. The ETF may choose to reinvest the dividends received from the preferred stocks back into purchasing additional shares of the holdings. This compounding effect can lead to growth in the ETF's share price over time. However, this is a secondary strategy and relies on the reinvestment of dividends rather than focusing on capital appreciation within the individual stocks themselves. Key takeaways. The PFFA ETF achieves its income objective by holding a basket of income-generating preferred stocks and prioritizing those with reliable dividend payments. Active management plays a crucial role in selecting and weighting the preferred stocks within the portfolio to optimize income generation and manage risk. Capital appreciation is a secondary benefit that can arise from price increases of the underlying stocks or dividend reinvestment, but it's not the primary focus of the ETF. Does the PFFA ETF have any specific sector or industry weightings? Yes, the PFFA ETF, or Virtus InfraCap US Preferred Stock ETF, does have specific sector and industry weightings, but these weightings might differ from a traditional stock ETF due to the nature of preferred stocks. Here's a breakdown of what to consider. Focus on issuers with consistent dividends. Unlike standard ETFs that might weight holdings based on market capitalization or industry trends, the PFFA ETF prioritizes issuers with a history of reliable dividend payments. This can lead to sector weightings that deviate from the broader market. Examples of potential sector weightings. Financials. Financial institutions like banks and insurance companies are frequent issuers of preferred stocks due to their need for stable capital. The PFFA ETF might have a higher weighting in the financial sector compared to the overall market if it finds these companies offer attractive and reliable dividend yields. Utilities. Utility companies often have predictable cash flows, making them another potential source of consistent dividend-paying preferred stocks. The PFFA ETF could have a higher allocation to the utilities sector if it aligns with the income generation objective. Consumer staples. Companies in the consumer staples sector, like those selling food and beverages, tend to have stable demand for their products. This stability can translate to reliable dividend payments from preferred stocks issued by these companies. The PFFA ETF might have some weighting in this sector based on the availability of attractive preferred stock options. Underweighting sectors with lower dividend focus. Sectors where companies prioritize growth over dividends might be underweight in the PFFA ETF. Examples include technology or biotechnology companies, which often reinvest their profits for research and development rather than issuing high dividend preferred stocks. How concentrated is the PFFA ETF's portfolio? The concentration level of the PFFA ETF's portfolio is a crucial factor to consider when evaluating this investment. Here's a breakdown of what concentration means in the context of the PFFA ETF and how it might impact you. Concentration definition. Portfolio concentration refers to the number of holdings within an ETF and the distribution of investment across those holdings. A highly concentrated ETF holds a relatively small number of securities, with a significant portion of the total assets invested in just a few holdings. Conversely, a less concentrated ETF spreads its investment across a broader range of securities. Concentration in the PFFA ETF. The PFFA ETF typically holds a moderately concentrated portfolio compared to some other ETFs, particularly those tracking broad market indexes. This means it might invest in a few dozen to several hundred preferred stocks. Factors affecting concentration. Active management. Unlike passively managed index ETFs, the PFFA ETF's holdings are chosen by the fund manager based on their analysis of individual preferred stocks. This selection process can lead to a more concentrated portfolio compared to an index that holds hundreds or even thousands of securities. Focus on specific characteristics. The PFFA ETF prioritizes preferred stocks with reliable dividend payments. This focus might limit the investable universe and lead to a more concentrated portfolio compared to an ETF that invests across a wider range of stock types. Impact of concentration on investors. Higher potential returns. Concentrated portfolios can outperform broader market ETFs if the fund manager successfully selects high-performing preferred stocks. Increased risk. However, concentration also amplifies risk. If a few of the holdings in the PFFA ETF underperform or experience significant price declines, the overall value of the ETF could be significantly impacted. Lower diversification. Compared to a broadly diversified ETF, the PFFA ETF offers less diversification, which can expose you to greater volatility from specific sectors or issuers. What is the expense ratio of the PFFA ETF? The expense ratio of the PFFA ETF, Virtus InfraCap US Preferred Stock ETF, is 2.52%. This represents the total annual fund operating expenses that investors incur for holding the ETF. Here's a breakdown of what this expense ratio means and how it impacts your investment. Expense ratio explained. The expense ratio is an annual fee charged by the ETF to cover its operational costs, including management fees, paid to the fund manager for their services in selecting and managing the portfolio of preferred stocks. Administrative fees, covers expenses like legal fees, accounting costs, and operational overhead. Other operating expenses may include marketing, distribution, and custodial fees. Impact of expense ratio on investors. A higher expense ratio directly reduces your potential return on investment. The 2.52% expense ratio of the PFFA ETF means that 2.52% of the ETF's total assets are deducted annually to cover operational costs. This translates to a lower net return for investors compared to the gross return of the underlying holdings. Expense ratios can be compared across different ETFs to assess their cost-effectiveness. However, a lower expense ratio isn't always the sole deciding factor. You should also consider the ETF's investment objective, performance history, and other features. Expense ratio in context of PFFA ETF. The 2.52% expense ratio of the PFFA ETF is on the higher end compared to some broadly diversified ETFs that track major market indexes. These ETFs can have expense ratios as low as 0.1% or even less. However, it's important to consider that the PFFA ETF is actively managed. Actively managed funds typically have higher expense ratios due to the management fees associated with selecting and overseeing the portfolio. Alternatives to consider. If expense ratio is a major concern, you might explore passively managed ETFs that track preferred stock indexes. These ETFs generally have lower expense ratios. However, they may not offer the same level of potential return as an actively managed ETF like the PFFA ETF if the fund manager successfully selects high-yielding preferred stocks. Are there any additional fees associated with investing in the PFFA ETF? Yes, besides the expense ratio of the PFFA ETF itself, there can be additional fees associated with investing in it. Here's a breakdown of the potential costs to consider. Fees beyond the expense ratio. Brokerage commissions. When you buy or sell shares of the PFFA ETF through a brokerage account, you might incur commission fees charged by the broker. These fees can vary depending on the brokerage firm and the type of account you have. Some brokers offer commission-free ETF trades, which can be a significant advantage for frequent investors. Bid-ask spread. This refers to the difference between the bid price, the highest price a buyer is willing to pay for a share, and the ask price, the lowest price a seller is willing to accept for a share, of the ETF. When you buy or sell shares, you'll typically execute the trade at a price closer to the ask price, and this spread represents a small implicit fee. Tighter bid-ask spreads are generally preferable as they minimize this cost. Account fees. Some brokerage accounts have monthly or annual maintenance fees. These fees are not specific to the PFFA ETF, but apply to your overall brokerage account activity. Foreign transaction fees. If the PFFA ETF invests in any underlying preferred stocks issued by foreign companies, there might be additional foreign transaction fees associated with holding those securities. However, this is less likely for the PFFA ETF as it focuses on U.S. preferred stocks. Minimizing additional fees. Choose a commission-free broker. Several online brokers offer commission-free ETF trades. Consider trading frequency. If you plan to trade the PFFA ETF frequently, the impact of commissions and bid-ask spreads can be significant. Choose a broker with a low-cost structure for active trading. Be mindful of account fees. Opt for a brokerage account with minimal or no account maintenance fees if you are a long-term investor. Impact on investors. These additional fees can eat into your overall return on investment. Understanding these costs is crucial for making informed decisions about investing in the PFFA ETF. How do the fees of the PFFA ETF compare to similar ETFs in the market? The expense ratio of the PFFA ETF, Virtus InfraCap US Preferred Stock ETF, at 2.52% is on the higher end compared to similar ETFs in the market, particularly passively managed ones. Here's a detailed comparison. PFFA ETF expense ratio. The PFFA ETF falls into the category of actively managed ETFs that focus on a specific niche within the fixed income market, U.S. preferred stocks. Actively managed funds typically have higher expense ratios due to the management fees associated with selecting and overseeing the portfolio. Similar ETFs and expense ratios. Passively managed preferred stock ETFs. These ETFs track broad indexes of preferred stocks. Their expense ratios are significantly lower than the PFFA ETF, often ranging from 0.30% to 0.80%. Examples include First Trust Preferred Securities and Income ETF, FPE, expense ratio, 0.84%. Principal Spectrum Preferred Securities Active ETF, PREF, expense ratio, 0.55%. Actively managed preferred stock ETFs. There are a few actively managed alternatives to the PFFA ETF, but their expense ratios can vary. Global X Super Income Preferred ETF, SPFF, expense ratio, 0.48%, lower than PFFA. SPDR-IC Preferred Securities ETF, PSK, expense ratio, 0.45%, lower than PFFA. Cost considerations. The higher expense ratio of the PFFA ETF translates to a greater impact on your potential return. A 2.52% expense ratio means that 2.52% of the ETF's assets are deducted annually to cover operational costs, reducing the net return for investors compared to the gross return of the underlying holdings. However, simply choosing an ETF with a lower expense ratio isn't always the best strategy. You should also consider investment objective. Does the ETF achieve your desired investment goals, e.g., income generation in this case? Performance history. How has the ETF performed compared to its peers and benchmarks? Management expertise. Does the actively managed ETF have a proven track record with a skilled manager? How do the fees impact the potential returns of the PFFA ETF? The fees associated with the PFFA ETF, Virtus InfraCap US Preferred Stock ETF, can significantly impact its potential returns. Here's a breakdown of how these fees come into play. Types of fees and impact. Expense ratio, 2.52%. This is the most significant fee. It represents a yearly deduction from the ETF's total assets to cover operational costs, like management fees and administrative expenses. This directly reduces the potential return for investors. Let's say the underlying holdings of the PFFA ETF generate a 10% gross return before fees. After applying the 2.52% expense ratio, the net return for investors would be 7.48%, 10% to 2.52%. Trading fees, commissions and bid-ask spread. These fees are incurred when you buy or sell shares of the PFFA ETF through a brokerage account. While seemingly small, these fees can add up over time, especially for frequent traders. For example, if you pay a $10 commission fee to buy and another $10 to sell, that represents a 0.4% cost on a $5,000 investment. Account fees. Some brokerage accounts have monthly or annual maintenance fees. These fees are not specific to the PFFA ETF, but can further reduce your overall return if they apply to your account. Impact on compounding. Fees can have a magnified impact on returns over time due to compounding. Compounding is the process where your earnings generate additional earnings in future periods. Even a seemingly small fee like the expense ratio can significantly reduce the amount of money compounded over the long term. Investor considerations. When evaluating the PFFA ETF, it's crucial to factor in the impact of fees on your potential return. You should compare the expense ratio and potential trading fees with your expected return based on the ETF's historical performance and future outlook. Consider using a compound interest calculator to see how expense ratios can affect your investment growth over different time horizons. This can help you make informed decisions about whether the potential return of the PFFA ETF justifies its fee structure. What are the primary risks associated with investing in the PFFA ETF? Here's a breakdown of the primary risks associated with investing in the PFFA ETF, Virtus InfraCap US Preferred Stock ETF. 1. Interest rate risk. Preferred stocks are particularly sensitive to changes in interest rates. This is because they offer a fixed dividend payout, unlike common stocks whose dividends can fluctuate. When interest rates rise, the relative attractiveness of fixed income investments like preferred stocks declines. Investors can earn a higher yield by investing in newly issued bonds with prevailing market interest rates. This can lead to a decrease in the market price of existing preferred stocks, including those held by the PFFA ETF. 2. Call risk. Some preferred stocks have a call provision that allows the issuing company to redeem the shares at a predetermined price after a certain period. This can be disruptive for investors, especially if the call price is lower than the current market price of the preferred stock. The PFFA ETF's holdings might include some callable preferred stocks. While being called can provide a return of your principal investment, you might miss out on future dividend payments and potential capital appreciation if interest rates decline in the future. 3. Credit risk. Preferred stockholders have priority over common stockholders when it comes to receiving dividend payments during liquidation. However, they still rank behind bondholders in the capital structure of a company. If a company issuing preferred stocks held by the PFFA ETF faces financial difficulties, there's a risk of missed or reduced dividend payments, and even potential losses on the principal investment if the company defaults. The PFFA ETF might mitigate this risk by selecting preferred stocks with investment-grade credit ratings, but some credit risk remains. 4. Market risk. The overall stock market can experience periods of decline, impacting the price of the PFFA ETF. Even if the underlying preferred stocks maintain their fixed dividend payments, the price of the ETF itself can fluctuate based on market sentiment. 5. Concentration risk. The PFFA ETF holds a moderately concentrated portfolio compared to some broadly diversified ETFs. This means a smaller number of holdings represent a significant portion of the ETF's assets. If a few of the underlying preferred stocks perform poorly, the overall value of the PFFA ETF can be significantly impacted. 6. Management risk. The PFFA ETF is actively managed, meaning the fund manager's security selection and portfolio weighting decisions can affect the ETF's performance. If the manager makes poor investment choices, the PFFA ETF might underperform compared to its benchmark or similar ETFs. How has the PFFA ETF performed during different market conditions? Here's a breakdown of how the PFFA ETF, Virtus InfraCap US Preferred Stock ETF, has performed historically under different market conditions. Favorable market conditions. Bull markets. During periods of rising stock prices, the PFFA ETF can potentially benefit in a few ways. Positive market sentiment. Broad investor optimism can extend to the preferred stock market, leading to an increase in the market value of the underlying holdings in the ETF. This can result in capital appreciation alongside the steady stream of income from dividends. Potential interest rate stability. If interest rates remain stable or even decline, the relative attractiveness of preferred stocks, with their fixed dividend payouts, can increase. This can lead to a rise in the demand for preferred stocks and potentially a price increase for the PFFA ETF. Unfavorable market conditions. Bear markets. When stock prices experience a sustained decline, the PFFA ETF can also be impacted. Price declines. The market value of the underlying preferred stocks can decrease along with the broader market. This can lead to a decline in the overall price of the PFFA ETF, despite the steady stream of income from dividends. Rising interest rates. If interest rates rise significantly, the appeal of fixed income investments like preferred stocks diminishes. Investors can earn higher yields from newly issued bonds with prevailing market interest rates. This can lead to a decrease in the market price of existing preferred stocks, impacting the PFFA ETF's value. Performance compared to benchmarks. It's important to compare the PFFA ETF's performance to relevant benchmarks during different market conditions. Here are some possibilities. Broad market indexes, for example, S&P 500. This can provide a general sense of how the PFFA ETF performed compared to the overall stock market under different conditions. Preferred stock indexes, benchmarks that track the performance of a basket of preferred stocks, can offer a more specific comparison. This can help assess how effectively the PFFA ETF's active management strategy fared compared to a passively managed basket of preferred stocks. Does the PFFA ETF use any leverage or derivatives that could amplify risk? Yes, the PFFA ETF, Virtus InfraCap US Preferred Stock ETF, does utilize leverage, which can amplify both potential gains and potential losses. It may also employ option derivatives to a lesser extent. Here's a breakdown of how these elements impact the ETF's risk profile. Leverage. The PFFA ETF uses modest leverage to potentially enhance portfolio exposure and returns. The target leverage ratio is between 15% and 25% of net asset value, with a maximum cap of 33%. This means the ETF can borrow funds to invest an additional amount in preferred stocks beyond its total net assets. Amplification of gains. If the underlying holdings in the ETF perform well, the leverage can magnify those gains. For example, if the ETF's holdings increase by 10% in value and the leverage ratio is 20%, the overall return to investors would be 12%. 10% base return plus 2% from leverage. Amplification of losses. Conversely, leverage can also amplify losses. If the value of the underlying holdings declines, the losses are magnified. In the same scenario where the holdings decrease by 10% and the leverage ratio is 20%, the overall investor loss would be 12%, 10% base loss plus 2% from leverage. Derivatives, option strategies. The PFFA ETF may utilize option strategies, but to a lesser extent compared to leverage. The specific option strategies might not be publicly disclosed in detail. Potential for additional income. The ETF might use options like covered calls to generate additional income. Covered calls involve selling call options on some of the holdings, while still owning the underlying stock. If the stock price stays below the strike price of the call option by the expiration date, the ETF keeps the premium from selling the option and continues to hold the stock. However, if the stock price rises above the strike price and the call option is exercised, the ETF is obligated to sell the stock at the strike price, potentially foregoing further price appreciation. Potential hedging. The ETF might also use options for some hedging strategies, but this isn't the primary focus. Overall risk impact. Leverage significantly increases the risk profile of the PFFA ETF compared to an unleveraged ETF. Even modest leverage can magnify losses if the market moves against the ETF's holdings. The limited use of option strategies might have a smaller impact on risk, but the specific strategies employed can influence the overall risk profile. Alright, so we've unpacked a lot about the PFFA ETF. To wrap it up, let's revisit the key takeaways. Income generation. The PFFA ETF prioritizes income through preferred stocks, potentially offering a steady stream of dividends. Risk and volatility. Leverage and preferred stocks themselves introduce some risk. The ETF's performance can be impacted by interest rates and market fluctuations. Investment horizon. The PFFA ETF might be suitable for a medium to long-term investment strategy, think 3 to 5 years or more, depending on your goals and risk tolerance. Remember, carefully consider your risk tolerance and investment goals before jumping in. If you're unsure, consulting a financial advisor can be a wise move. Thanks for joining us today. If you enjoyed this breakdown of the PFFA ETF, don't forget to like and subscribe for more investment insights. In the comments below, let me know what other ETFs you'd like to see analyzed.